there was a special dividend earlier this year where you were distributing shares in specie, 145 ESR shares or 180 Straits Trading shares per 1,000 Straits Trading shares. Can you just explain the thinking behind that special dividend, and what is the overall dividend policy for the group?
The overall dividend has to be sustainable. Just one word, sustainable. Every time we divested, we have rewarded shareholders for it.
Okay.
And there's also a pattern, and that itself, I think, has created a value of $3.50 in total, combining all the value that we've given. Well, that kind of stock would mean that the shareholders looking at it from a long-term point of view, maybe a defensive point of view. It's not aggressive. I mean, you won't buy Straits Trading to be aggressive.
So I went with the Straits Trading option.
Good choice.
Simply because I felt that I was getting more value.
Yeah, it was intentional anyway.
It was intentional?
To just round it up to slightly higher.
Okay.
Yeah, it's just a matter of rounding up, right? 145 ESR share versus...
So it was intentional to give
180,
investors who took the Straits Trading shares option better value?
Yeah, I mean, just slightly. I mean, it depends. The value changes every day in the stock market.
Can you explain the thinking behind that model of forming partnerships, and how do each of these partnerships work?
In the context of the three-pronged strategy, partnership is one, but quickly I just want to mention the first two. We must be in markets that we know, we are familiar with, okay, know your business. And I think secondly, we must be able to appreciate the kind of risks that we are able to go in. Of course, you want a good high return, at the same time, must be risk adjusted. Last but not least, you can't be alone in almost everything in today's world. You have to work with partners. That's not the difficult part. The difficult part is finding the right partners, the suitable partners. That's the difficult part.
Can you just talk a little bit about how SRE works? You know, how you find opportunities?
Firstly, on the macro basis, I think each period of our strategy would rely on what is most tax efficient and what is most risk efficient and what is best return for a period of time. In the last 10 years, clearly, we identified private equity, and as such, we could see a lot of so-called emphasis on SRE or Straits Real Estate. And in doing so, I think they themselves follow through very clear strategy in terms of entry, exit over about 3 to 5 years. Maybe today's market, maybe 5 to 7. The world has changed quite a bit the last 2 or 3 years. But having said that, our return is always very targeted to at least IRR of 10%. That is the least we want to achieve in all that we seek to do.
A big part of the group's business relates to property investments specifically. I can't imagine that high interest rates are going to be good for that.
Definitely, we have already taken step. Our shareholders will be pleased to know that we've taken step. The most proportion of our loan, we put it down as a fixed rather than just a floating rate. Okay. But of course, we also look at building the war chest. We did a very successful medium-term notes a few months back. We raised it at about 4.1%, which seems very cheap today. But obviously, at the point in time, nobody knew it's going to be cheap.
One segment that has sort of lagged behind is the hospitality business. Can you give us a sense of what the outlook is?
A good example of scaling and focusing on the business of growth is the hospitality business.
Okay.
From what we have ran the Rendezvous business with just 3,000 rooms, by scaling it with Far East and ourselves combining to scale it with Toga, it's about today 20,000 rooms. So that's just an example of scaling what you had 3,000 rooms right up to 20,000. But you don't need to own 100%, right? So you own 30% now of the joint venture. But it is still a business very much in play. Much as the pandemic have derailed it for the last 2-3 years, but everybody know hotel is back. If you minus off the pandemic, the last 3 years, largely it's been a lot of growth. New hotel, new this. So the return may not be so forthcoming.
Right.
Yeah. So I think over time, now that we have got out of this, hopefully we've got out of this pandemic, then I think the growth, the resurgence is going to be there. Yeah, clearly in play.
The group made an investment in Asdax Financial It now has a 14.3% stake in it. Are you becoming a fintech?
As a so-called conglomerate, we certainly want to look at the various so-called relevance in the market, and today fintech is relevant. So a good example of how the fintech fits in with what I'm saying earlier about the fractional property is that if I were to fractionalize 30 million bungalow to say $500,000 for you, you could afford it, maybe not the small investors. But the small investors could afford it if they go to SDAC, where they could tokenize it smaller to say, for argument's sake, they say 20,000. I don't know how much they're going to tokenize it. So let's just say 20,000. So there's a big difference. So they could afford that. So the fintech is an extension, a clear extension of what we are doing. So that's why we're invested in that. So if you buy a fractional property from me, the control is yours. Nobody's going to force you to keep it forever. There's no lockdown period. So you want to sell, we'll find the liquidity in the market to do it. And one liquidity is the SDAC platform.
So there's a lot of questions about the relative illiquidity of Straits Trading shares.
Particularly the last 3 years, we have grown the investors base by a big amount. I think we have about 6,500 investors today. But we don't want to stay illiquid forever. That's just an excuse if you stay there forever. So at the capital market, we've done our very best to do what we can. So sometime early this year, in January, we did our very first share placement. By any measure, it's a success because, as you said, people look at us illiquid. So why would people want to be invested in us in the first place? So I think we're happy with the result. We raised about 80 million. People did say that, but you're going to give a discount, 8.9%. But I think that's justifiable because it's a strategic percentage given our trading volume and trading pattern. And to prove the point that it was a good decision, the next guy who do it was a large global REIT. They gave 9%. So we're not far off.
Yeah. Counter is currently trading at discount to net tangible assets. What are your plans to narrow that discount?
I think I speak on behalf of my management colleagues, my board, and especially my chairman, who you could ask her any one time of the day, she'll tell you what upset her is people not appreciating our share prices. But that discount has been what it is. Right, 50%, 30%.
So she thinks it shouldn't trade at a discount?
It shouldn't. All of us think, everyone. Yeah, okay. And any time of the day.
You've heard it from him.
So what are we doing to work on it? Like what you said, we are doing to try to narrow it in many ways. I think, needless to say, at the corporate level, there should be corporate activities, corporate action we need to take to create the liquidity. And to give you a simple example, a very humble, modest example, even that 80 million that was raised as a result of the 26 million placement of share, was only about 6%, but I think we managed to create some form of liquidity, which is not bad. We could look at the last 3 years, the average weighted as well as the volume traded. It's all not bad, it's improved. It's much better than before, but of course no big deal compared to some of our other peers. But this is where an initial step we'll take and we'll move forward with that. We'll find ways to do more if we can, with the right partner, also with the right business. At the same time, hopefully the company itself will one day be something that more people will embrace and hold it for what its value is, and not hold it for a discount.